Canopy Growth just cemented itself as the #1 medical cannabis provider in Canada. But it turns out wearing that crown comes with a pretty brutal short-term hangover. Welcome back to Earnings Unscripted. It is June 15th, 2026, and we are unpacking Canopy Growth, ticker CGC. And their fiscal Q4 2026 results were, well, they were definitely a mixed bag.
Mixed is putting it politely. Look, before we dig into why, quick disclaimer that this is just our personal opinion and definitely not financial advice. Do your own math. But stepping back, Canopy's balance sheet is actually looking kind of incredible. They transitioned into a $131 million net cash position. But then you flip over to the income statement, and it is a totally different story.
Right, because the headline numbers are rough. Revenue came in at $71.2 million. That's down about 4.5% from $74.5 million last quarter. And then EPS worsened to an 18-cent loss compared to an 18-cent loss. And margins, Miro, the gross margin shrank from 29% all the way down to 12%.
A 61% plunge in gross profit. You see that and assume the cool weed business is just falling apart. Except it actually didn't. Most of that margin collapse is directly tied to $10.7 million in inventory write-downs. They essentially threw away overlapping product lines after they acquired MTL Cannabis just to clean up the warehouse. So buying their way to the top of the medical market just had an immediate penalty.
It is the literal cost of doing business when you buy your way to #1. And the stock price reaction was, honestly, it was kind of a shrug. The stock trended down about 27% over the quarter, mostly drifting lower. But on earnings day itself, it spiked a tiny bit at the open and then just faded all day. Extended hours were entirely flat, like zero change.
Because the market is looking past the messy accounting of the integration. They want to see what happens next. But the operating loss is much harder to ignore. That spiked 263% quarter over quarter. They posted a $95.8 million loss.
But wait, a massive chunk of that was Storz Bickel, right? The premium vaporizer brand?
Yeah, exactly. Over $61 million of that was an impairment charge hitting their hardware business. Storz Bickel revenue dropped 26% quarter over quarter, down to $16.8 million. They're just facing really weak demand in the U.S. and Germany. Turns out selling high-end vapes to consumers who are feeling inflation is a pretty tough pitch right now.
I mean, people still want the flower. They just don't want the $300 gadget to use it, which honestly feels like a very relatable, very human shift right now. We keep the essentials and ditch the accessories. But we need to unpack how they're going to handle this hardware reset, plus that wild curveball from Veterans Affairs Canada that forced them to basically rewrite their medical playbook. All right, let's get into the details.
It is fascinating how a single stroke of a government pen can completely rewrite a profit model. You brought up that Veterans Affairs Canada policy earlier, and that is actually the hidden drama here. Canada just cut the medical reimbursement rate for eligible veterans. They dropped it from $8.50 a gram down to $6.
Which sounds like, maybe a small drop for a single demographic, but for Canopy, that is their core market. Veterans are this massive insured base that is a guaranteed recurring revenue stream getting slashed by almost 30% overnight.
Yes, exactly. And when your best paying patients suddenly lose their coverage limit, they look for cheaper options. So Canopy had to they had to alter pricing and roll out loyalty retention plays just to keep those patients from churning.
And they actually pulled it off because Canada medical revenue still grew 12% this quarter to $25.3 million. That was a record quarter for them. So they essentially outran the cuts.
They did pull it off, but you pay a steep price for that growth. You keep the patient, but you compress your own margin profile moving forward, which kind of feeds directly into the other major shift happening right now, the physical footprint reset.
So you're talking about beyond just the inventory cleanup we discussed.
Way beyond paper losses. They are taking physical assets offline. The CFO, Tom Stewart, was very blunt about the near-term pain. On the call, he said, let me find the exact quote. He said, We are moving through a transition period as the two organizations integrate. As a result, we may see slower growth in the first half of fiscal 2027.
So the next 6 months are basically a construction zone.
Or demolition, I guess. Demolition is right. They are completely shuttering their Kelowna cultivation facility in British Columbia. Gone. They are shifting all the output focus to their Kincardine site and the new Quebec facilities they got from MTL. And this is actually the detail I loved. The CEO admitted that MTL's real secret sauce was simply their ability to grow great flower consistently.
Which is, you would think a multi-billion-dollar cannabis company would have figured out the actual farming part by now, but growing consistent product at scale is notoriously difficult.
It really is. It is an agricultural scaling problem that a lot of these massive companies failed at. So Canopy essentially spent the last 2 months taking MTL's green thumb talent, their lead growers, and injecting those protocols into their broader operations. It is almost a talent acquisition disguised as a corporate merger.
Right. They bought the recipe book. So while they spread that knowledge around, they are warning us that revenue is going to be slow. But wait, they're also projecting positive adjusted EBITDA for this full year, 2027. How does that math work if the top line is under pressure for 6 months?
Synergy extraction. They targeted $10 million in run rate savings alongside the MTL deal, and they've already realized $6 million of that. Plus, if you back out the crazy $10 million inventory charge we talked about earlier, Stewart noted their adjusted EBITDA loss this quarter would have been significantly closer to break even. So the underlying engine is actually getting leaner.
It's just covered in all the sawdust from the restructuring right now.
Sawdust and, well, unsold inventory in Europe. Because even as the cultivation side tightens up, you still have Storz Bickel dragging the numbers down.
That vaporizer reset we hinted at.
Right. They just launched a new product called the VZ, and the entire marketing pitch is affordability and portability.
Which is a total pivot because they've always been the ultra-premium device in the room. The luxury hardware you leave on your coffee table.
Precisely. But when the macro environment stresses consumers in Germany and the U.S., people just stop buying $300 devices. So the VZ is a compromise. Its management openly admitting their luxury moat cannot sustain the division in this economy.
They have to meet the consumer where they are at, even if it hurts the brand prestige a bit, which honestly, that pragmatic approach seems to be the theme of this entire quarter. They're facing reality. But it really makes me wonder how all this defensive positioning sets them up for what happens next, especially with all the legislative noise around the U.S. market.
Right. Everyone expects this Canopy USA entity to just unlock massive value tomorrow, but management essentially poured cold water on that idea. CFO Tom Stewart explicitly noted that until there is a real uplisting potential for fully plant-touching businesses, Canopy they do not see the same immediate benefits as some of their U.S. peers. So you really cannot rely on legislative headlines right now.
Which means they have to save themselves. A Canadian house is the only thing that matters right now. And that brings us to their actual outlook. They are aggressively guiding for positive adjusted EBITDA in fiscal year 2027, but investors are going to need some serious patience.
Yeah, because the promise is completely back-end loaded. They are actively warning about slower growth and near-term revenue pressure in the first half of the year. These next 2 quarters are basically the integration tax. They have to finish closing the Kelowna facility and actually capture those synergies before things inflect.
It is the classic corporate medicine strategy. You swallow the bitter pill today so the financials look brilliant in 6 months. But honestly, I think I respect it. For so long, this entire sector was just built on pure hype and infinite scale. And now we're watching Canopy literally shutter farms and roll out budget vapes to protect cash flow.
It's gravity catching up. They are finally operating like a traditional consumer packaged goods company. You stop selling the dream and you start optimizing your supply chain. It's not glamorous at all, but it's how you actually survive a down cycle. Assuming they actually hit that second half target, of course.
Exactly. The proof will be in the second half. Until then, it's less poetry and a lot more actual farming. We'll definitely be watching those margins next quarter to see if the engine is catching.
I will keep my spreadsheet ready.
I know you will. All right, I think that brings us to a solid close. Thanks for wading through the weeds with me today, Miro.
The weeds. Very subtle. See you next time, Sizzy.
Before we completely wrap, if you want these unscripted earnings drops to just show up for you, feel free to follow the podcast. Just a quick aside too, we generate this show with the help of AI, feeding at the actual financial filings, so the analysis is completely grounded in real data. If there is a company you want us to pull apart next, or you just have feedback, drop us an email at earningsunscripted@datamadness.ca or find the X link in the show notes. See you after the next bell.